Craig, good morning.
Good morning.
Thank you very much for doing this again. Very interested to know what's been going on with Alliance Trust since we last talked to you. But I'll give you a chance, as usual, just to sort of introduce the fund and tell us a bit about what you're trying to do, please.
Yeah, no problem, James, and thanks for the opportunity to talk through it. We actually had the annual general meeting of Alliance Trust just the other day, and so just got back from that, and there's been a lot of positivity from shareholders on the back of that. So I thought I'd share some of the things that we talked about in that presentation, but also great opportunity to go through lots of questions around the trust. But yeah, probably the first place to start is just set out what the objective of the trust is, and that's set out on here. But ultimately, it's all about long-term patient investing. We're looking to deliver strong long-term returns through a combination of both capital growth and, importantly, a rising dividend. And indeed, we've managed to do that for 56 years in a row now of increasing dividends. We are a dividend hero under the AIC, which is anyone with more than 20 years of increasing dividends every year. Of that elite group of trusts that have been doing this for more than 20 years, we've actually had the strongest dividend growth over the last 5 years of all of them. So that's an important part of it, but ultimately it's around getting good long-term returns. And we're confident that if we do that, then we'll significantly outperform both the benchmark, which is the MSCI All Country World Index, and the peer group over the long term, as we've done so far, and we'll talk through as we go through. So a reminder of how we actually deliver that objective. Ultimately, it is a multi-manager approach. So that came in place on the 1st of April 2017, so 6 years ago, and we'll talk through how things have gone since that point. But essentially, our job is to pick what we think are the world's best stock pickers. So that's us at WTW, Willis Towers Watson. We pick who we think are the best stock pickers in the world, and then manage a portfolio, putting those managers together and ultimately choosing managers that are quite different. Again, I'll go through that. What we think this brings is these 6 things put up here. So first of all, diversification. I mean, the big advantage of this multi-manager approach here is that you're not beholden to the skill of one individual or indeed one asset management firm, but perhaps even more importantly, you're not beholden to the style of any one particular approach. And so there's no reason why it has to do particularly poorly in specific market environments. We've got an approach that can work in any market environment. So that's the principle there on diversification. But importantly, we do that slightly differently to other multi-manager approaches in that it's very high conviction. So we ask each of the stock pickers that we've got in place to just run their very best ideas in a portfolio. So these are segregated accounts run specifically for Alliance Trust, and they have a maximum of 20 stocks that they're allowed to own. So just give us their very best ideas, and we'll worry about risk control in terms of how we blend those managers. They should think about risk more in terms of permanent loss of capital in the companies that they're investing in. So that allows us to produce significant outperformance despite the advantages of all that diversification that I alluded to. And importantly, we can do that with competitive costs. And so because Willis Towers Watson advise on a few $1 trillion of institutional capital, we have a relatively unique situation of very, very strong buying power with the asset management community, and we've been able to keep the OCR on this below that of many single manager approaches, let alone all the multi-manager approaches that are out there that are much more expensive. And so that's a key advantage of this approach. And we've been able to bring exclusive access to managers that aren't typically available in UK retail space, or if they are, you certainly wouldn't be able to get access to their best ideas 20 stock portfolio. But I'll talk through some of the managers in a moment to give or bring that to life essentially. Now, we do all of that through a sustainability lens. To be clear, this isn't an ESG or sustainability or impact fund per se. Everything's around getting the best long-term returns over the long term. But ultimately, we think being strong in sustainability allows you to get better returns at lower risk. And so it's a big part of what we do. It's embedded in everything. We'll only pick managers that we think are strong on the sustainability side. And we also do a lot on the engagement and stewardship side, both in terms of encouraging the managers to vote on everything, but also we employ EOS at Federated Hermes on top of all of this to do engagement on our behalf with the underlying companies. And they're one of the world's largest and best renowned engagement overlay specialists. And then finally, we do all that with this backdrop of increasing dividends every year. As I say, we're not going to break that streak of 56 years. So that's the summary of what we do. Perhaps if we dive into the next slide, what we've got there is the current manager lineup. And actually, this manager lineup hasn't changed in the last 12 months. The last change we had in a manager was back in the first quarter of 2022. So this is the lineup. There's a few things I'd bring to light here. Firstly, that point that these aren't just all names that are well known in UK retail space. Some of that is because a number of them are not based in the UK, and indeed it takes some work to find some of these organizations. So Black Creek at the top there are in Toronto, and Vulcan Value and top left next to them are in Birmingham, Alabama. And so these aren't well-known names, some of these. And even the ones that are well-known, as I said, you wouldn't be able to get access to their 20 stock best ideas portfolio anyway, other than through this approach. Now, you'll see there, we've got different weightings to each of the managers. One thing I would point out is GQG have two slices of the pie there. So whereas everyone in this lineup runs a 20 stock best ideas portfolio, GQG are the exception that they also run an emerging market portfolio for us. That's the 6% slice there, but all the others are a 20 stock best ideas portfolio. The second point I'd make is that each of these managers are very, very different. And so, that's not just that some are more value oriented than others and some are more growth oriented. It's also that, even within the value space or the growth space, they're very different in how they come at the problem. So, Lyrical, as an example of a value manager, they will start with all of the US large and mid-cap companies, and they will say, what are the cheapest quintile of stocks? So the bottom 20% in terms of valuation, and then really dig into which of those companies are not cheap for a reason. They are companies that are very strong, producing good earnings, are going to continue to produce good earnings, and actually you're just buying them at an incredible bargain. That's their kind of approach, whereas someone like a Vulcan Value that will refer to themselves as a value manager will actually be starting quite differently with what are the great companies that you'd want to own for the very long term, and then which of those can you find at very discounted prices, and that's often not going to be the case. And so they'll typically run very concentrated portfolios, 10, 15 stocks for us with that maximum of 20, but they tend to be at the lower end of that because they're not often finding those. So they're both value managers, but you would never get overlap in the kind of stocks that they're owning, as an example. So just thought I'd bring that point out. And then the weightings really are a function of two things. Firstly, the unique risk characteristics of each individual manager. Some are running higher risk portfolio than others. They might go down the cap spectrum, for example, more into mid and small cap, whereas others are more in the large cap space. Or they might be looking for very out of favor situations rather than quality growth companies. And so we take that into account in their weighting. And then also the main thing is how they all blend together at that particular point in time. And ultimately what we're trying to achieve here is to ensure that stock selection drives everything. And so if we flip to the next slide, we bring that out a little bit on the point that what we try and do is keep some of the big macro factors to a minimum so that that stock selection does come through as the key driver. And so here we've got the actual weights on the left-hand side for the sector and geography of the portfolio, and then how that looks in the chart relative to the benchmark, which is the MSCI All Country World Index, as I mentioned before. And the key point here is they are very small positions at a sector level. Yet most of them are in the 1% or less situation, some of them 2-3%, but those are quite small positions at a sector level. It's much more around the stocks that they're buying within the sectors. Similarly, on the right-hand side, you don't get very big country positions. That said, at the moment, there is a significant underweight to the US, partly because the benchmark has got up to 60% plus in the US, and partly because the stock pickers are just finding a lot of good opportunities outside of the US today, rather unsurprisingly, given that the US stock market has been one of the best performing over quite a few years. And then finally, and perhaps most importantly on this chart, no real style biases. Those are very small positions. They're only really particularly big if they're getting to sort of plus or minus 1. The biggest of the lot is the one that we'll typically structurally have, which is a slight underweight to large and mega cap stocks and a slight overweight to mid cap in particular. And that's, a function of, if you're telling people to run their very best 20 stock ideas, it's unlikely that on average they'll always be in the largest, most highly covered stocks that have by definition gone up the most to become the largest market cap. So that is a bit of a structural bias, and that has been a big headwind actually for the last 5 years or so, where large cap has driven everything, or mega cap in particular. But other than that, the quality, growth, value, momentum, they'll move around, but in very, very small positions, we're pretty much always style neutral. So that's kind of the backdrop as to how we do it. Obvious question is, well, how's it gone? So as I said, we started managing this portfolio in this structure on the 1st of April 2017. So it's been around 6 years. Obviously, the trust itself has been around well over 100 years, but in terms of the current approach to the multi-manager, it's from that 1st of April 2017, and that's the piece on the right-hand side. So over that full 6-year period, total shareholder return and NAV total return are there. That total shareholder return represents a cumulative return of 60% over those 6 years. So a good outcome. If you go back to that objective of producing real returns over the long term, we've certainly done that. And with a rising dividend, well, as I said before, dividend increases have been very significant, up 26% last year versus the year before, and the highest of all the dividend heroes over the last 5 years. Perhaps the period I would pull out is the last 3 years, not because they're the biggest numbers. Yes, outperformance of 17% per annum over those 3 years, but it's actually quite an interesting period, the 3 years to the end of March 2023, because it's from the bottom of the equity fall post-COVID. So that was literally March 2020 that was at the bottom, and so that's an interesting period through there. And you've seen that return of 17% per annum over that period. At the bottom, what we've got is over each of the periods how we've performed in NAV terms versus the 3 obvious comparators. So the index benchmark that we've been set, the MSCI All Country World Index, which by the way has been one of the best performing portfolios out there. This has been a really tough period for active management, given that the market's been led by a small number of very large growth companies, notwithstanding 2022. If you take that whole 6-year period, that's certainly been the case. And then the other 2 being the peer groups. So the middle one there, the investment trust peer group, that's the other global equity investment trusts that are out there. So it's the AIC global sector average. And then the wider peer groups, that's the wider Morningstar one that includes all of the open-ended global equity retail funds, as well as the investment trusts. And you can see over all of those periods, against all three comparators, we've done very well, in particular over the more recent periods, 3 years, 2022 in particular, and year to date, but significant outperformance of the peer groups, 4 or 5% per annum, depending on which one you take over that 3 years, and almost 2% per annum relative to the benchmark, despite that performing pretty well over that period. So very encouraging performance, I would say, and certainly shareholders seem to be very happy with the approach that's been in place for the last 6 years. And we were getting that feedback at the AGM. Now, one of the things that we like to do is try and pull out, well, what's actually led to that performance, because that might give you a better feel for what you can expect going forward from here. And so the way I tend to talk about this is that if you invest in a public equity company, there's kind of two ways you can make money. So the first is what we call fundamental growth. That's this fluorescent purple color piece of this. And that's effectively if you bought the entirety of the company. So if you took it private, bought the entire company and held it forever, you would just get given the earnings that company's producing, the dividends it's paying, but it would all go to you. And over the long term, that is what you would get back for the price you paid to buy that company. And that purple piece is all about how have the earnings and dividends been progressing in the companies that we've been owning compared to expectations, compared to the market, all of those things. The second way you can make money, which is the more browny type color there, is that whilst you're owning this entirety of the company, Mr. Market is offering to pay you different amounts depending on how the market feels, the sentiment about that particular company. And that's typically driven by more short-term things like current interest rates, and hence what price earnings multiple they're willing to put on that particular company at that particular point in time. And so that's the multiple expansion piece of things. And so we try and break down how much of our returns have come from each of those and how much of the returns from the index have come from those. And what you'll see is that a much higher proportion of our returns have come from fundamental growth than has been the case for the index. Now, you might then say, well, so what? And the so what is on the right hand side there, in that over the very long term, it's only really the purple that matters. Multiple expansion and contraction in companies happens through time, and in the short term it will bounce around your paper profits or outperformance of an index, but over the long term, ultimately, if you pick great companies that beat expectations on their earnings, that will come through in the share price. And so this leads us to believe that there's actually quite a lot of latent value in the portfolio. And if we flip on to the next slide, we just remove those brown bits, just keep the purple bits to make it clearer. And what it shows is that, you know, if you just took that over that full 6-year period, we would have outperformed just on that fundamental growth piece by 1.8% per annum. And on the right hand side, we've got over the last 3 years, we'd have outperformed by 6.8% per annum. So that's why we sit here pretty excited about our view that yes, we've started to see some very strong outperformance in the last year or two, but actually we think there's potentially quite a lot to come, because the stock pickers do seem to have been doing what we'd expect of them, taking a long-term view, finding companies that are producing more than was expected and the market was anticipating. And some of that has come through in share price improvement, but some of it hasn't. And we were talking to a number of the managers just this week where they were giving examples of companies that have beaten expectations on earnings, significantly beaten even their own expectations of when they got into the stock. And yet in some cases, the share price has almost halved just because of a short-term view on interest rates. But the manager hasn't changed what they're doing. They've continued to own those companies throughout. So that's some of the backdrop as to why we're excited. Maybe to put this in context, though, whilst we've got a very positive view from a bottom-up perspective on the companies we're owning, we have to recognize in the short term, there are always this Mr. Market piece, this short-term fluctuations in macro events that provide some risks to short-term performance. We look at that and we see that currently bond markets seem to be signaling that a recession is likely to take place, whilst equity markets are generally not saying that's going to be the case. Maybe a little bit of tail off in earnings, but not a recessionary scenario. And so we've got a little bit of caution about the market as a whole, and hence our current gearing levels are a little bit below that typical strategic position of 10%. We're still constructive. We've got gearing in the portfolio, but less than we might have on average through time, given that caution. But we do think volatility creates opportunity for those stock pickers that know where to look. And on the next slide, we just point out that one of the reasons we've got some confidence that things are starting to price in fundamentals rather than just big macro events are that you're starting to see more dispersion in stock returns and in sector returns. We've got the sector one on here as an example, but we think that's going to continue to be the case through time. And clearly there are lots of companies that have done really well in an era of free money with very low interest rates and no recession. It will be interesting to see what happens if we go to the next slide as that era of free money comes to an end. It's going to be much more around the strength of companies, and given that latent value we talked about on the fundamentals, we think that could be an interesting time. So final slide before I just hand over to you, James, is just, how does the portfolio look given all of that backdrop? Well, we think we've got something that looks particularly attractive, both on a valuation perspective. It looks cheaper than the benchmark, but also at the same time as having higher and more stable earnings growth in the portfolio. And you don't often get the opportunity over a diversified portfolio to be able to do both of those things. And it's for some of the reasons that I've talked about that we don't think fundamentals have been fully priced into markets just yet. A lot of macro events have been driving markets. And so we sit here today pretty excited about the future.